Good afternoon to everyone. Welcome to WindAPAC Digital Series webinar produced by Leader Associates. And this is Mabel, today's host, as well as a part of the organizing committee of WindAPAC Digital and Australia Wind Energy 2021. In 2021, Leader Associates built a new education online platform for wind power industry named WindAPAC Digital. As physical gathering is still risky for most protectionists in most countries or regions, especially in the first half. And the pandemic almost stops the international travel, but the travel of intelligence is not interrupted. The key stakeholders, including the regulators, the power generators, the grid operators, and contractors, will gather under one roof to talk on how to accelerate the wind power development from their perspectives. And this year, we put great focus on Vietnam, Japan, Australia, and South Korea, since they are most promising markets in APAC in terms of both onshore and offshore. We're happy to bring most up-to-date local market information to international specialists by internet and provide international specialists to a stage to share their leading solutions online. And today it's my pleasure to host the first webinar of WindAPAC Digital. And firstly, I'd like to introduce the theme of today's webinar, the pros and cons of available pricing mechanisms, FiT versus auction versus PPA. There are several available pricing mechanisms in Australia's electricity market. The most usual one is to put wind power into spot markets, while the pricing is fluctuating. On the other hand, an increasing number of power generators are employing power purchase agreements, while the expected revenue is relatively stable. You can learn from a few local specialists with rich portfolio in this session and to see which one is suitable for you. And the webinar is set up to help the international companies to have a comprehensive understanding of Australia's wind power generation market. Furthermore, we'd like to share the latest trend, issue, and innovation along with a large number of domestic players. And this time, I'm pleased to have Aylin Cunsolo from Baker McKenzie and Stephanie Easton from Infigen Energy speaking on the topic. And yes, before the presentation starts, please note each speaker has 25 minutes for the presentation. And following that, we will have 5 minutes for Q&A session, and we will show a few questions selected from the pre-registers on the slide. And if there's some time left, 1 or 2 questions from live audiences will be answered by the speakers. And okay, let me just introduce the first speaker, that is Ms. Aylin Cunsolo, partner from Baker McKenzie. Aylin is partner in the energy and the projects team. She specializes in renewable and clean energy project development, energy regulator matters, and energy contracting, including hedging and offtake arrangements, connection arrangements, and the retail arrangements. She also advises on significant energy and resources MMA transitions and the unit cooperated and the incorporated joint venture and shareholder arrangements. Aylin is a member of the Technical Advisor Committee to the Business Renewable Centre Australia, and she will give an introduction of the available pricing mechanisms for wind power and how they will go through a project cycle in a regulator basis. Hi, Aylin.
Hi, Mabel. Thanks for that introduction. I'll just share my screen now.
Yes.
Now, is that okay?
Yes, it's great.
Great, thank you. And hi to everyone. It's great to be talking with you today. As Mabel mentioned, I'll be going through some of the pros and cons of different pricing mechanisms that are available, looking at feed-in tariffs, auctions, and PPAs. Before I get into the different mechanisms that are available, I just wanted to set the scene in terms of the policy environment here in Australia for encouraging renewables. The renewable energy target has really been the key driver of renewables in Australia. In 2019, in September, the Clean Energy Regulator announced that Australia had met the target more than a year ahead of the schedule. At this stage, we haven't heard, or the federal government hasn't announced any replacement scheme. But essentially, the renewable energy target enables the creation of tradable renewable energy certificates for large-scale projects, that's LGCs. And electricity retailers are required to surrender a certain number of LGCs every year against their customers' electricity consumption. So electricity retailers will purchase renewable energy certificates or LGCs off generators. And we're also seeing corporates doing the same thing where they have voluntary emission reduction targets. Corporates are buying renewable energy certificates off generators and then cancelling them as a way of meeting their voluntary emission reduction targets. So aside from the renewable energy target at the federal level, each state in Australia has set its own policies for encouraging renewables. And this slide here shows each of the targets at the state level. And there are various policy levers that sit underneath these targets as a way of meeting the targets. And that includes auction processes and PPAs, which are the type of mechanisms that I will go through shortly, as well as direct investment. So moving on now to a comparison of available pricing mechanisms. So the first one to look at is feed-in tariffs, and these essentially guarantee the purchase of renewable energy under a long-term PPA, either as a set or cost-based purchase price. A feed-in tariff is usually set for an individual technology, such as wind and solar, and is paid for a fixed number of years. They often gradually decline over time in order to stimulate cost-reducing innovations in the sector. Some advantages of feed-in tariffs are lower complexity. They're often used to promote different or initially less competitive technologies or smaller technologies. So for example, in Australia, there's feed-in tariffs in each state for rooftop solar for residential or C&I customers. The feed-in tariffs will provide predictable revenue streams, and it can allow, so from a policy perspective, long-term planning when it's applied well, and has been successful in stimulating rapid and large-scale investment in several countries, particularly early on when renewable energy was first being encouraged. Some of the disadvantages are that the scheme can be costly and may require continual adjustments. And globally, it's tended to be more successful in a regulated economy rather than a wholesale electricity market economy like what we have here in Australia. The different types of feed-in tariffs models include a gross feed-in tariff, where the feed-in tariff is paid for all generated energy independent of whether the energy is being exported or not. A net feed-in tariff, which is payable for renewable energy exported to the grid. Net metering, where the current retail price is paid for all renewable energy that's being exported, or net billing, where the payments for electricity generated and consumed are netted out over a certain period of time. One case study or example of a feed-in tariff instrument in Australia was the reverse auction feed-in tariff scheme, which was introduced by the Australian Capital Territory, the ACT government, and that was in 2011. It created a reverse auction FiT scheme for large-scale and commercial solar power systems, where renewable energy generators were guaranteed a feed-in tariff through a competitive process. Companies were required to provide proposals to the government as to how they could generate the greatest amount of energy at the least price. and that they were then evaluated for feasibility and cost effectiveness. The scheme ensures that feed-in tariffs are paid for up to 210 megawatts of renewable energy capacity, and that capacity was released in instalments, with the first 40 megawatts being dedicated to large-scale solar technologies and released for auction before the end of 2011. That capacity was designed to power 7,000 homes, reducing emissions by 850,000 tonnes over the lifespan of the project. The feed-in tariff process involved 4 different auction processes, and I've listed here some of the successful projects in receiving the feed-in tariff offer, and they sort of include projects developed by FRB, GPG as well, and a few others here. The second type of revenue stream that I'll discuss is renewable energy auctions or tenders. And this is where the government will specify a capacity or electricity generation which is up for auction and technology type. That should say megawatts rather than kilowatts. Apologies for that. The price and quantity for each eligible project are determined through a competitive bidding process. And then the government will enter into a PPA with the winners for the bid process. And I will go into how PPAs are structured in the Australian market a bit further on. I mean, the real advantage of a renewable energy auction process, which is run by the government, is that you're contracting with the government, who's a bankable counterparty, and as part of the process, you'll end up with a contract which will provide a stable revenue guarantee. The disadvantages is that it can be a very intensive process. There tends to be a number of stages to get through, shortlisting and then negotiation, and that can be difficult for sort of smaller developers, just in terms of the costs that you have to spend to get through the procurement process when it might not necessarily be successful. And the processes are very competitive. There's a lot of desire to get a contract out of these processes. One example of this kind of renewable energy auction scheme in Australia was the VREP process, and that supported the Victorian government's legislated target for renewable energy generation to be 50% by 2030. The scheme was developed to support the achievement of the VRET, and the first one was held in 2017, and currently the government is considering a VRET 2. So as part of that VRET 1 process, the government called for bids from projects through a sort of a formal request for proposal. This included up to 550 megawatts of large-scale technology-neutral renewable energy and up to 100 megawatts of large-scale solar energy. The proponents were required to bid for a long-term support agreement and were assessed against formal evaluation criteria. So some of that criteria included price, value for money, the project's contribution to local economic development, best practice community engagement, benefit sharing and job creation, the project's impact on electricity network infrastructure, and the capacity and capability to ensure that the project will be delivered. And finally, the projects were selected were the ones that could deliver the best value for money and achieve the objectives of the state. And it resulted in development of 928 megawatts of new renewable energy projects in Victoria. So these were the successful candidates or projects for the 2017 reverse auction. And as I mentioned, the Victorian government has announced that it's intending to undertake a VREP 2 reverse auction process. and it's undertaking a market sounding process at the moment. So it released a consultation paper in September 2020, and that says that the government is considering different auction sizes for the VRET2, such as 600 megawatts or 600 plus megawatts. It's also looking at different design options, such as inclusion of dispatchable technology like energy storage systems, the potential coverage of Victorian government load, either virtually or directly. So that would be sort of like a type of corporate PPA, as well as scope to provide additional transmission and network support given the current and future outlook of the power system in Victoria. Some of the other options that could have impact on the design include potential role of electricity retailers, integrating energy storage into the auction, managing price and volume risk when it exceeds the Victorian government load, and managing delivery risk to achieve a commissioning target date of December 2024, which is what the government has indicated it will need. So moving on now to the sort of the third type, and that's a renewable PPA, and this PPA structure is also used in the government sort of auction process. But what we're really talking about here is PPAs on the market, agreed bilaterally between a generator and an off-taker, and that off-taker in the current environment could be a corporate customer. We're seeing a large number of corporates entering into PPAs directly with developers, or it could be a retailer. So this structure here is representing a wholesale PPA. And this is a traditional PPA structure for the wholesale market, the national electricity market in Australia. It's a financial instrument structured as a contract for difference, where the off-taker will pay a fixed price to the generator, and the generator will pay the spot price to the off-taker, and the PPA will settle on the difference calculated per trading interval. You'll often see, as I mentioned at the beginning of the presentation, that the off-taker will also buy the LGCs, or renewable energy certificates that are generated by the project. And so this structure, from the project's perspective, allows it to get a fixed revenue rather than being exposed to the volatility of the spot market, and that'll allow the project to get financing from banks if private finance is needed. So in the current market, we don't typically see a PPA for 100% of the offtake, but it will be for the majority of the electricity generated by the project, which is then enough to get the guarantee of fixed revenue, but also allow some portion of exposure on the spot, so that the generator can sell on a merchant basis and receive that income. The second type of PPA that we're now seeing is a retail PPA or a supply-led PPA, and this kind of structure is where there's a retailer involved, so as to facilitate a product for the corporate customer. There's a few different options in the way you structure this, but ultimately there will be a retail contract between the corporate customer and the retailer, and that'll be underpinned by a PPA with the project, which will be structured in the same ways that I've spoken about just now. For this kind of product, will give the corporate customer, it will allow it to make sort of certain claims around the PPA, so sustainability claims, but it's still more like a retail contract and provides electricity supply to its sites. But it's likely to be a longer term than sort of your standard 2 or 3 year electricity retail contract. In some circumstances, again, the customer will be buying LGCs, and it might buy the LGCs directly from the generator, or it might buy those through the retailer. The customer might transfer those back to the retailer so as to offset their environmental charges under the retail contract, or they might cancel the LGCs to meet voluntary sustainability claims. So we're seeing this kind of structure with generators who have a separate retail arm. So for example, Pacific Hydro has a related retail company, Tango, and has entered into PPAs like this, where their generator, Pacific Hydro, will enter into a PPA with their related company, Tango, who then has the contract with the customer and can provide a renewable energy retail electricity agreement. And finally, the other sort of PPA structure that we see in the market is a behind the meter PPA. And this we can see this structure on a large scale, for a large scale project. It's more common for sort of your rooftop solar type situation, but we do see, for example, mine sites or other large production facilities. If there's land vacant next door to the facility, a project can be developed and supply electricity directly behind the meter. From the customer's point of view, this gets access to cheap renewable energy without having to pay the network charges, which are really a large proportion of the bill. So this is it's a good structure for both the generator and the customer, but it does require opportunity in the sense that you need the available land next to a customer where you can supply directly. Here are just some of the key issues. I won't have time to go through them today, but just to give you a flavour of the type of risks or key terms that are negotiated under a PPA. So, for example, commissioning obligations is important, particularly in a wholesale PPA. So, where an off-taker is contracting with a developer who is developing that project, there'll be deadlines as to when the project needs to be developed by. So, typically a target date for developing, for achieving commissioning of the project. And if that target date's not met, then there'll be an obligation to pay liquidated damages, which are calculated based on the expected revenue that the buyer would have received during that delay period, but typically negotiated also to reflect what the generator is getting from its EPC contractor in terms of delay LDs, so that the generator doesn't have a significant gap risk between what it needs to pay the off-taker and what it gets from its EPC contractor for delay. If the project's not commissioned by a sunset date, then typically there's a right for the off-taker to terminate, and sometimes they might get compensation for their transaction costs for procuring the PPA. Some other issues that are dealt with is change in law risk. Generally, a PPA, both a wholesale PPA and retail PPA, will include provisions around what happens if there's a change in law that increases the generator's costs. In a wholesale PPA, the standard position is that those costs will be passed through on a 50-50 basis between the generator and the off-taker, so that you share the increased costs related to change in law. In a wholesale PPA, there's typically also minimum generation obligations, and if you don't meet those, an obligation to pay liquidated damages, which again will be based on the loss of revenue that the buyer would have otherwise received had the project been generating at full capacity. So just touching on some of the advantages and disadvantages of a PPA. And this is really the most common form of offtake agreement in the market. It's a private arrangement, so you don't need to wait for a government to come up with their own scheme or go through the auction process. It can be simpler, to procure and negotiate for that reason. We do see corporates running tenders, and so that's a process that you go through, but would not likely to be as intense as a government-run tender. There is also, opportunity just to bilaterally agree a PPA with a buyer. However, it is a buyer-friendly PPA market. They're not easy to come by. The prices are. It's a tough market at the moment in terms of pricing as well. So there is sort of it can be difficult to find that opportunity. Particularly solar. There's for wind, there is demand for wind, but it still is a buyer-friendly market. And that also influences negotiation as well as the key terms. The other thing, in terms of a renewable PPA in the market is that the credit worthiness of the off-taker is really critical. Obviously, with a government-run feed-in tariff or auction, you're dealing with the government, and that's very attractive. It's a reliable income that you'll be receiving, and then an easy contract to bank on. Whereas if you're dealing with a corporate off-taker, you really have to examine their creditworthiness, and the typical position of the banks is that if the off-taker is not investment grade, they'll be required to provide credit support, and that's usually equal to 12 months expected revenue under the PPA. So just touch on now sort of some of the current opportunities in the market. So as I mentioned, VRET 2 market sounding underway. There was also a sort of a public standing renewable energy RFP process that's almost finished now with expressions of interest due this week. The New South Wales government has released a roadmap, and in that it's indicated a reverse auction process is planned. In Queensland, there was a reverse tender. The shortlisting is complete on that. However, it has sort of put aside $145 million to establish 3 Queensland renewable energy zones, and that's designed to support significant investment in renewables. So that's one that will potentially become available. And there are also sort of various corporate PPA tender processes that happen from time to time, and there's specialist consultants that tend to run that, like Energetics and Schneider. And that was it for my presentation. So happy to take any questions.
Yes, we did have some questions from our registers. Yes, let me share the screen about the questions. I will speak it out for the audiences. The first one is, which type of pricing mechanisms can escape from the grid constraints as the grid congestion is happening in Australia?
Yeah, thank you. Look, the constraints in grid congestion is a point of negotiation in any PPA. So I don't think there's any sort of one structure that's going to get you a better outcome. It really comes down to negotiation with the counterparty, whether that be the government or a private counterparty. And it's relevant in 2 contexts. One is during the commissioning process, what happens if there's a connection delay that prevents you from being able to meet your achieved deadlines. From a generator side, you want to try and get relief for that kind of event, but there is a bit of pushback from the buyer. In the context where there are a lot of connection delays, that should really be, from their perspective, that should be factored into the into the timetable. So where we're sort of ending up in many agreements is a sharing of a risk. So you might get relief if there's a very long connection delay that could not have been reasonably foreseen, but say a month or two, connection delay because of congestion, or because of high, work on the NSP, then that's just something that that a generator needs to take risk on. So we sort of see a sharing of approach there. In terms of during the PPA, often a buyer will try and exclude any kind of grid issue from being giving relief from minimum generation obligations. However, again, we tend to find that is negotiated. The generators will take sort of ordinary constraint risks that just happen from time to time, but in terms of significant constraints like what we've seen in the West Murray region, typically you want to be trying to carve that in as a force majeure kind of relief, and there should be ability to do that.
Thanks, Aylin. And about the second question is, the audience would like to know more about the level of economic competitiveness of each mechanism option.
Sorry, I didn't quite catch that. Could you just speak up a bit louder or pop it in the tasks in the chat for me?
I think the audience would like to know about the economic competitiveness of each mechanism option.
Sorry, I just can't hear at the moment. Do you mind just popping it in the chat?
Hi, Aylin. Can you see the slide?
Yes. Yep. Level. Okay. Sure. So, look, in terms of a PPA, I think as I alluded to before, it is a buyer-friendly market. So in terms of pricing, it's really competitive, and look, that applies in both a PPA negotiated with a private party, as well as a PPA negotiated with the government. So there's quite low prices, probably the lowest it's been in Australia, over the last few years. So it is a bit of challenge in that sense. What it gets you is certainty of revenue, and that allows a project to be banked. And as I mentioned, we tend not to contract for 100% of the offtake. You're sort of looking for something less than that, say, maybe 70%, so that the remainder can be sold on the spot market, and you receive a revenue in that sense. In terms of sort of outside of pricing and negotiation, there's more room to move in a private PPA. I think in terms of government processes, you tend to get the terms, and it's very difficult to negotiate. So that can impact on the competitiveness. But again, I mean, the government should really have advisors who are aware of what's bankable, at least, so that you're not required to sign up to something that couldn't then get financed.
Thank you, Aylin. Thanks for your answering these questions. And if audience still have some questions, you can also leave your questions in the Q&A box at the bottom of the screen. Aylin will be online and answer you. And let's move to the next part. That is welcome to the second speaker, the Stephanie Easton, the Manager of Operations Control Center from Infigen Energy. Based out of Sydney, Stephanie is the manager of Infigen Energy's Operations Control Center, who are responsible for the 24/7 operation of Infigen's assets. Stephanie's role is to ensure Infigen's 940 megawatt portfolio of wind, gas, and battery generation assets are optimized, operated, and dispatched into the national electricity market. This includes maintaining awareness of site-based activities, optimizing bid and dispatch strategies, analyzing operational performance, and managing compliance. And Stephanie also has a Bachelor of Engineering of Renewable Energy and the Bachelor of Commerce of Business Economics from the UNSW. And she will be discussing from the asset operator side to evaluate the pricing structures, and her speech title is Why the Devil in the Detail When Contracting Variable Renewable Energy. Hi, Stephanie.
Hi, Mabel. Thanks for the introduction. I'll just begin sharing my screen. All right, thank you for the introduction, Mabel, and thanks everyone for the time to tune in this afternoon. My name is Stephanie Easton. As Mabel just introduced, I work with Infigen Energy and I'm in our Operations Control Center, which is the 24/7 team we have at Infigen. We do both operational monitoring of our assets, which are largely wind assets, but we do have firming assets as well that we own and operate. I also manage our bidding into the spot market, which means that we constantly have a finger on the pulse of the market dynamics that we see in the NEM. And we get to see how different technologies interact in that market and how it has been evolving over, well, the last 10 years now, but at least from my eyes, the last 5 years. Today, I'm going to talk from really a developer and a generator's perspective on these different pricing mechanisms that have already been introduced this evening. And I'm going to have a bit of a look into why it's really, really important to be careful about the details that do go into longer term agreements for the offtake of variable renewable energy, and how in order to have sustainable investment in the Australian market, it's quite important that the long-term understanding of the implications of any type of contracting arrangement is known, because it may be that it's leading to a negative detriment of any future investment that may be made. To begin, I'll give a quick overview of who Infigen is as a company and try and give a bit of an insight into the background that we have when it comes to contracting and participating in Australia's electricity market. So Infigen is what we like to call, I guess, the utility of the future. And that is that we have a large portfolio and access to a large amount of renewable generation, which is predominantly wind generation. We have owned fast start firming generation. And by having these two technology types within our portfolio, what we're able to do is provide customers with reliable and competitively priced energy. And that means that Infigen is a retailer, and predominantly we retail to commercial C&I customers. And these customers, we're very open to meeting their needs in pretty much any way that they want. But what we think is that customers want access to a firm supply of electricity, and we manage the risk to ensure that that's the case. Last year, Infigen had the fortune of being acquired by Iberdrola. For those who don't know, Iberdrola is one of the largest utilities in the world. They very much, if we want to call Infigen the utility of the future, I think Iberdrola as a company were leaps and bounds ahead of Infigen. And so the acquisition last year has opened many doors for Infigen as a company. And we're now, I think, a part of a very powerful and large group who we have a lot to learn from. What this has meant is it's also really been able to boost the growth objectives of Infigen as a company in the Australian space. Just got up here as well the growth plan. So we're now part of a company that has really large development pipelines, and so we're really actively involved at a global level within the Iberdrola group in terms of understanding, I think, the questions that are being raised today about contracting structures that make sense and really on a sustainable basis. Both Infigen and Iberdrola have been owning, operating, and looking to contract or at least find routes to market for wind and renewable generation for coming up to 20 years each. So over this time, I think the message has been quite clear, and we're quite aligned, I think, with our parent company now, the importance of being able to not only invest in the projects that we have right in front of us, but ensure that our next project also has an opportunity to get off the ground. Quickly on details, we have 7 owned wind farms. We contract from 4 wind farms. So when we're talking about contracting of variable renewable energy, it's probably also important to note that Infigen is both, I guess, the seller as well as off-taker of firm contracts for renewable energy. So we've kind of had experience in both sides. And that means in my role, I look at how you dispatch and think about dispatch decisions, both as an off-taker as well as a seller of plant that has either part or a full capacity contracted. The firming assets that we have 2 OCGTs in the markets where we have the largest presence, which is New South Wales and South Australia. We also have a 25 megawatt 2-hour battery in South Australia, co-located at our Lake Bonnie wind farm. And we have a portfolio of customers. So what we retail to is commercial and industrial customers. So these are customers that typically have the largest loads. And we have a diversified portfolio of customers across Australia. I thought I'd also touch on that maybe for international guests, the market that we have the most experience in and that I'll be relating to today is the national electricity market, which covers a large proportion of Australian electricity supply. It's an interconnected market that runs from Queensland down to Tasmania and across to South Australia. The market design is one of the more deregulated ones internationally, so it's an energy-only gross pool market. The market that gets dispatched every 5 minutes, which is one of the quicker timeframes on an international scale for energy-only markets. Price is determined by balancing supply and demand, whilst also factoring in the limitations of the electricity network. And I believe it's the most volatile commodity market in the world, if not one of them. And it means that as a participant, we're looking at prices every 5 minutes that can range anywhere from negative $1,000 per megawatt hour to $15,000 positive megawatt hour. And in recent experience, you can see a couple of weeks ago, I think whenever I look for a screenshot of volatility in the NEM, you never have to look back too far. What I've just put a screenshot of was the market 2 weeks ago. Over a 3-day period, we went from around 6 hours where price was consistently moving up to that $15,000 price cap to 2 days following where price would drop all the way down to that lower bound of negative $1,000 and sat for 6 hours at around negative $500 2 days later. This volatility is definitely increasing through time, and it's something to be quite aware of, that realistically the outcomes from the spot market that we have in the NEM is the financial kind of marker that any contract is being assessed against. All energy in our market must go through this gross pool, and our contracts really sit as a derivative on the side to manage this risk financially. So I thought I'd start from really a generator developer point of view. What's our overarching view of the different contract mechanisms available? And to start off with is what's the motivation? And I think that it was touched on quite nicely that realistically, you're looking to gain revenue certainty and ensure that you have dependable cash flows for any new asset, to be able to service debt, to be able to get financing in place, and also to provide sustainable funding for a business, in our case, that's looking to grow. So we don't just want to build the projects that we have nearing completion in our development pipeline today. We want to make sure that we can build, another project in a few years' time and be able to achieve a steady rate of growth. And so to do that, we need to make sure that our business does have dependable cash flows. We also need to think about these contracts have a more affinity with variable renewable energy projects as they are quite capital intensive. And so there's a large financial commitment upfront. The intermittent nature also is, I guess, a risk that's quite specific to variable renewable energy projects like our wind and solar. So the two, I guess, tariff options that being addressed today, if we're thinking of a feed-in tariff or a power purchase agreement, feed-in tariffs have been historically backed by a public entity like the government. And I think that some of the larger deployments or longer term deployments have really been at a domestic scale. The nature of a feed-in tariff when it is done on a domestic scale is typically that the price is set up front and there's less certainty that necessarily the objective of the policy is going to be achieved. So feed-in tariffs for renewable energy, they're very much aligned with our decarbonisation goals and also with being able to, I think, get technologies off the ground. So we've definitely seen them at a domestic scale for rooftop solar, and then at a government scale to encourage renewable energy investment. I think, and then to move to power purchase agreements, this for us these days is the most common agreement that we look to. They're typically underpinned by a contract for difference as the financial mechanism. The off-taker, you can have a varying degree of off-takers. It realistically is a financial contract, but retailers historically the most common. Large customers is increasing appetite for, and I think as was touched on, their willingness to take on risk varies quite significantly. So you've got some large customers these days who are willing to take a PPA directly and manage their consumption risk around that variable supply of renewable energy. And there's others who realistically want a retailer in between to provide more of a firm product. The managing of leftover risk when you balance supply and demand, I think is the real underlying tenet that should be thought about both for projects today and also thinking through into the future. So customers see it, but even when contracting with retailers, it's a risk that I think project developers typically are looking to shift to that retailer. Both of these are production linked contracts, and that helps provide the certainty of revenue and de-risk the variability. From a generator and a developer point of view, there's not a strong preference from Infigen to date between these two products. The overarching goal is to de-risk that product and provide revenue certainty, and both of these types of options are able to do that. What's more important, I think, is really the details behind each of these contracts, and that will have to do with who the counterpart is and potentially what the objective of that counterpart is in putting the agreement in place. So in saying that, I wanted to run through a few examples of where I think over the last, say, 5 years, we've really seen that you'd almost say unforeseen risks have developed in the spot market, and it's really having a ricocheting effect into the types of terms and conditions that you're starting to see in power purchase agreements or even just firm agreements for variable production going forward. Probably the most talked about one is marginal loss factors. So following the kind of RET review a few years ago, there's been a surge of renewable investment. And out of that, there's been a concentration of generations in some certain parts of the network. And what that's fed into is, I think that there was large shocks across the grid around 3 years ago when marginal loss factors started to be released. So marginal loss factor is the losses that are assumed for each generation asset. It's a static loss that is applied to all generation for a 12-month period at an asset basis. So a 1% decrease or a 1% increase in losses effectively eliminates 1% of production for that generator for a fixed year period. What we saw is much more than 1% drops in MLFs. And what this chart is showing is in North Queensland. So North Queensland saw an influx of utility solar generation. And what we saw is that all the generators in North Queensland, but in particular those solar farms, had really drastic drops in their marginal loss factors. This, when you have a production-linked PPA or contract, this is a risk that appeared for essentially the seller of the contract that wasn't necessarily priced in most of those contracts when they were first struck. The other market trend that I wanted to point out is that volatility in the market is increasing. So on the left, there's a chart of demand in South Australia, and conversationally, we always talk about a duck curve developing with the increase of rooftop PV. And South Australia is a region where this is really starting to see quite accentuated, but I can show the same chart for every region of the NEM, and the trend is developing through time in a very identical fashion. That is that the demand starts to reduce significantly through the middle of the day. So two distinct peaks begin to be formed when demand is at its typical highest before solar starts kicking in. So it's an early morning peak and an evening peak. This variability of demand throughout the day starts to demand more flexibility from generators within the grid. And because we have supply versus demand-based pricing mechanisms on a 5-minute basis, this variability tends to encourage volatility, which if we look at the chart on the right, this is really a dispersion of prices in South Australia over a 15-year period. And what we can see is that kind of regardless of the movements in the average price, the range of prices that we're typically seeing is starting to widen. So our high prices are becoming higher and our low prices are becoming lower. To build that into how we think about demand, so when we're thinking about that duck curve, we can see that demand for electricity across the grid is starting to decrease in the middle of the day. So in the last year or two, the amount of minimum demand records that have been set across the NEM are eye-watering. And the key reason is that rooftop or distributed PV is driving down the amount of electricity that needs to be supplied from utility generators in the middle of the day. And what that's starting to lead to on this chart is really an increase in negative prices. So this is a count of trading intervals, so 30-minute periods, which is what we currently settle on in the NEM, where prices settled below $0. South Australia is kind of the serial offender of seeing negative prices, as it's been the region in the NEM with the highest penetration of renewable energy relative to demand. And it's not a very well interconnected region, which means that there's large periods of the time where any additional generation is only going to drive down price in South Australia, as opposed to be exported to Victoria to kind of serve demand elsewhere in the NEM. What we started to see over the last 18 months, however, is that Queensland has started to see an increasing amount of negative prices in the middle of the day. So this is heavily driven by increases in both residential and utility solar. Victoria, there's been an influx of renewables in Victoria as well, growing at quite a steady rate. And this is also helping to drive down prices in the middle of the day in Victoria. And with all of that, South Australian negative prices continue to increase. And kind of, I think one of the final market observations is this has meant that the distribution of prices that we see in the NEM has rapidly changed. And so for projects that are looking at average prices over long periods of time to be able to come up with a price that's fair to strike in a PPA or that can be competitive in a tendering process, it's a complex game to solve. The price dynamics are changing rapidly in the NEM. This here is a comparison of the I guess, bin prices for our first quarter of the year. So that's January to March for the last 7 years. And what we can see is there's been massive swings in the types of prices that you'd expect over your summer period. Summer is the high demand period of the year, and it's when we typically see the most high price volatility. And a 3-year trend has been that there's been a step change shift in both the median as well as average prices that we're seeing through Q1. And so the Q1 prices up until a couple of weeks ago that we're seeing this year were some of the lowest that had been seen in many, many years, and not necessarily sitting at levels that would be sustainable for future investment. And finally, constraints. So I think many developers and generators would be aware of constraints and how hard they can be to predict and then manage once they're in place. So the curtailment of variable renewable energy, in particular due to non-economic reasons, is still continuing to grow. So as the grid is rapidly changing with technology types and a drive for decarbonising our grid, there's limitations just in the physical capacity of the grid as generation centres start to move, as new renewable zones pick up. But there's also new problems evolving in the grid that aren't necessarily being foreseen. We've had many reactionary measures come in place that have taken typically years as opposed to months to fix at a grid scale. So the Northwest Victoria region is one example, but we've also had large amounts of system strength issues in South Australia that are yet to be solved. These types of developments can have large production impacts, not just on new generation, but incumbent generation as well. And so thinking through all these drivers, it's important to acknowledge how variable renewable energy, and particularly the different contracting structures that have historically existed, might be playing a bit of a part in these types of dynamics, and why there can be a bit of a, I'm not going to say death spiral, but there can be negative impacts of having contracting structures that may not be sustainable long-term to both incumbent projects, but also the health of future projects. So I think it'd be fair to say that there's just unforeseen risks that continue to develop in the Australian NEM. And there's historically been a strong trend where really the off-taker of a PPA takes a large amount of this market risk, with the objective being that you want to de-risk a project so that you can get project financing. But there's been a few lessons learned, and so I think off-takers have probably been burnt enough that there's changing terms in PPAs, and I suspect that this will continue to be the case. For example, it's now common for price floors to be existing in any contract, and so this is the seller or the developer of the project or owner taking on risk for negative prices. The uncertainty around change of law gets more and more complicated as there's different state-based measures, as well as federal uncertainty about climate policy. And then what's folded into that is being market redesign questions with the ESB's post-2025 process recently. And so the policy risk is continuing to grow. Loss factors, I think it's fair to say that they're studied now more than ever before. And there's probably been quite a few instances out there, particularly I think if we're saying North Queensland, Northwest Victoria, and potentially even South Australia, where minimum generation guarantees potentially aren't being able to be met for factors that are seemingly out of incumbent participants' control. What it's worth pointing out though is that negative prices, as an example, is something that very much is being driven by large amounts of VRE in the middle of the day. And while this impacts all generators, there's definitely probably a disproportional negative impact on the renewable energy generators. We have a very decentralized decision-making grid. And so I think that there's been quite a few projects who've had the misfortune of locating near other projects, or other projects have been developed in quick succession. And subsequently, they've all been impacted with bad MLFs. And I think in terms of trying to manage constraints or prioritize dispatch because of the contract terms, we've probably seen an increase in the prevalence of extreme negative prices because of that bidding behavior, and I guess a lack of market-facing assets in the grid. And so from that, I wanted to run through probably some of the considerations to think about when thinking about the type of contracting that will make for sustainable investment in the NEM going forward. It's quite clear that renewable energy is well positioned in Australia to play a key role in decarbonising our grid, but also meeting our Commonwealth Paris commitments. Australia has great renewable resources and definitely has good resource for the cheapest renewable technologies of wind and solar. In saying that, typically, I think an economist's view would be that the closer the link between a policy objective and the mechanism that they actually use means that they're more likely to be able to succeed in achieving their policy. So the renewable energy target, I think, has been really effective at achieving increased production from renewable energy. And I think that there's a fair amount of studies out there that show an emissions trading scheme, for example, could be even more effective. What we're seeing is that absent kind of new federal policy coming to light, state governments are setting their own objectives for growth in renewable energy, and as such, putting in place their own policies to encourage this. What is being seen with these policies, particularly ones where government continues to be the counterparty of a PPA offtake, is that new projects, there's probably a phenomenon that develops when new projects effectively transfer wealth from all other generators in in the NEM, but in particular variable renewable energy. And so objectives to increase and encourage renewable energy really give value to some projects, but decrease the value of other renewable energy projects. And so there can be some, not necessarily short-sightedness, but I think adverse reactions in terms of policy objectives. That really at times can raise issues for the types of projects that are being awarded PPAs and potentially not sustainable projects for future investment. So at a planning level, projects where production is prioritized as opposed to necessarily energy being useful can cause issues where we do see this increasing of duck curve or driving down of prices at certain times of the day, or worsening of other participants' MLFs. And so it's important that when I think consulting on government-led policies and when thinking about how can Australia be set up to be a sustainable location for renewable energy investment, is that players continue to provide feedback to ensure that the mechanisms that we're using at government levels will promote sustainable investment going forward. Particularly, it's a decentralized market, and I think that there's a lot of private sector investment in place. And so it's important to ensure that short-term objectives aren't at the detriment of being able to have those longer-term self-sufficient investment from the private sector. And I think the point there is that consumers want low-cost electricity, but they also want it to be reliable. I'll quickly run through, I think, almost a case study of the New South Wales roadmap at the moment and a potential opportunity for thinking through the sustainability of investment in New South Wales. So we already have in place the renewable energy target, and New South Wales are looking to do some type of reverse auction process. What Infigen's been proposing is that this process, instead of looking to auction off CFDs, it should look to auction off LGC certificates. One of the key reasons is that the modelling is suggesting that the New South Wales roadmap project will do a large transfer of wealth from all generators in the NEM, realistically, to the generators that are successful through this tender process. And so what you can see on the right is that just this policy alone is going to have around an $800 million cost over a 20-year modelling period to the market. That potentially can sound really, really attractive if you think you can be one of the projects that win that tender, but typically we don't see PPAs in place for the lifetime of a project. And so even for individual projects, there still typically is a time where a project needs to refinance. And so while it feels like it's efficient pricing to have this drive down in price, it potentially can increase the risk of projects that then need to go back to refinance. And with what we've got in the NEM at the moment is we're about to come up to a really large period of projects needing to refinance. So this is data that's been gathered from speaking within industry and gathering information that's publicly available. And it indicates that, to the best of our knowledge, there's $5 billion in both 2022 and 2023 of renewable energy investment that will need to refinance their projects, with increased risk that prices may severely decrease or collapse below sustainable levels. It both puts these projects at risk, but also other projects that are looking to get financing. And so, as touched on, Infigen's suggestion at the moment is that the New South Wales government considers using a reverse auction, however, for LGCs as opposed to CFDs. Reverse auctions are really quite competitive, really effective historically at driving down the price outcomes, and can be quite competitive and get really good outcomes. And so we think that could be a much more manageable way. The risk that we're seeing is that when these types of costs are taken on and contracts are struck at unsustainable levels, any cost is still passed through to consumers, but typically through fiscal measures. And so anecdotally, it looks like the Victorian VRET is costing Victorian taxpayers around $250 million per year. So it's not to say that there's anything wrong with lower prices. It's, I think, exactly what we're looking to ensure that policy achieves, but it needs to be at levels that are sustainable, because if new renewable investment can't be encouraged, I dare say the price forecast that we look at going 20 years into the future will change quite rapidly with that uncertainty and change in generation mix. And it'll also mean that it might be harder to achieve our decarbonisation goals. So in conclusion, variable renewable energy is going to be key in trying to decarbonise Australia's electricity grid and meet our international climate commitments. It will continue to make sense to contract these projects going forward so that they can be de-risked from an investment point of view and generate a steady cash flow for any business looking to invest. As an industry, though, it's important that we're encouraging policy measures that encourage new investment, but don't unfairly erode the value of existing renewable energy that is also equally contributing to the benefit of decarbonising our grid. And it's possible to value the benefits of renewable energy while also keeping projects market facing and responding to what we have as a rapidly evolving energy system. So that's it from me. Thank you.
Hi, Stephanie. Thanks for your impressive speech. And now we see some questions on FiT. The first one is, the audience would like to know more predict the trend of marginal loss factors within NEM. I think it's about the MRFs in the NEM grid, right?
So I think, as much as I can try and predict marginal loss factors, it is the question of the moment, and it's a really complicated question to solve. I think it's important to always look at, I guess, first principles when thinking through the likely marginal loss factor of a project. The developments in recent years has seen AEMO start to take a bit more of a central planner role with the publication of the Integrated System Plan, and I think firming up the renewable energy zones. So whilst I think trying to predict marginal loss factors is a bit of witchcraft and wizardry, and definitely we, as much as we look at the grid consistently, have definitely been caught off guard, and always post getting an unfavourable MLF, I think you can rationalise why. But I think it's something that you need to really continuously think about and look at other developments. And so, yeah, I think it's really, really hard to predict. I'm quite hopeful that with more concentrated and coordinated planning around renewable energy zones, that the shocks that have been seen historically aren't seen again. But I think the fundamentals of having large amounts of generation, potentially not near load centres, and needing to travel long distances to meet a load centre, will, that's the fundamentals of why we're trying to factor in losses and encourage investment in useful places throughout the grid.
Okay, let's move on to the next question is, what's the impact of digital tools with respect to the various pricing structures for renewables in Australia? And also, how do you see this evolving in the coming time?
I think digital tools really equip us to better understand the dynamics of a market system that is very volatile and I guess an artifact of the decisions that everyone else is making. We're really in a decentralized planning system that looks to encourage the private sector to innovate and invest in really the lowest cost way of meeting the needs of electricity demand. And so where tools come into this is, I think that participants being engaged and trying to collect as much insight and I guess additional IP about the dynamics of the market, how it's evolving going forward, is something that I think is definitely a good analytical problem for people who want to be investing in this market to investigate. Some of those kind of unforeseen risks, I think that there'd be probably a few old souls in the electricity grid who'd say that they completely weren't unforeseen risks. And so I think having the complexity and insight to be able to better model the grid, understand developing risks, and understand the dynamics that might play out within our spot market means that developers and off-takers can be better informed about potential risks that will develop and also the potential viability of projects. And this hopefully can help with both deciding which projects to build, as well as understanding which technology is going to be required to meet the needs of consumers.
Thanks for your answering, Stephanie. And also I would like to here express many thanks to our respectful speakers' presentations. And I hope all the audience can learn a lot from Aylin and Stephanie by today's WindAPAC Digital. And furthermore, yes, I would like to express many thanks to our speakers. And I think they gave a very detailed presentation, the introduction of the available pricing mechanisms in Australia. And in addition, I'm delighted to announce that in addition to the virtual event, the WindAPAC Digital, we also have a physical event in Melbourne this July, named Australia Wind Energy 2021. And to celebrate the coming of Eastern holiday, we will launch 10% off discount, which is available due 11th April. And this event is a permanent information exchange and business networking platform between multiple stakeholders in the country's wind value chain. And yes, our speaker, Stephanie, will join us as well. And also, our next WindAPAC Digital webinar is on this Friday. It will look at the Japan wind market landscape with offshore wind power auction. Do not miss it if you're interested. And last but not the least, please kindly note the recordings of this webinar will be shared by email after 1 week. And many thanks again for our speakers and also audience participation. We are looking forward to see you next time. Thank you, Stephen. Thank you, Aylin.
Thanks, Mabel. Thanks all.
Bye.
Bye.
Thank you.